Good morning, everyone. Welcome, and thank you for joining us. It is our pleasure to open today Deloitte Banking Risk and Regulatory Academy. Over the course of the 5 focus sessions, starting from today until Friday, our Deloitte experts from across Central Europe will share practical insights on how banks can respond to evolving supervisory expectations, strengthen resilience, and turn regulatory change into a strategic advantage. Each session is designed to be practical, forward-looking, and directly relevant to your challenges that banks are facing right now. We encourage you to actively participate, reflect on how these topics impact your institution, and engage with our speakers throughout the week. Once again, welcome to our Deloitte Banking Risk and Regulatory Academy. We are delighted to have you with us. So, as mentioned, in the first session, we will cover regulatory agenda and supervisory priorities for 2026-2028, in which our experts will outline the key regulatory and supervisory focus areas for the upcoming period and discuss how banks can proactively align their compliance frameworks with the evolving supervisory expectations. I will start also briefly introducing the speakers for today. So we have Stephan Thouet. He's the leader of Banking Union Center in Frankfurt, with over 25 years of experience in advising international financial institutions, including coordination of on-site inspections and asset quality review engagements with ACB. Przemysław Szczygielski, he's our risk and regulatory leader for Deloitte Central Europe and leader of the financial services sector in Poland and Baltics. Spyridon Bisisidis, financial risk leader at Deloitte Greece. He brings a lot of experience in financial risk management, regulatory compliance, capital optimization, and he's also coordinating our geopolitical risk working group. Sascha Bakry, partner at Deloitte Austria, specialized in banking, treasury, capital markets, supporting clients on risk management, treasury strategy, controlling, and strategic transactional matters within financial services. And myself, Andrada-Tănase, I'm a financial services risk and regulatory partner in Deloitte Central Europe, based in Romania, with extensive experience in credit risk, capital and liquidity management, corporate governance, and regulatory compliance for banks and other financial institutions, as well as national competent authorities. Just very briefly, how to make the most of today. So we have a Q&A box, so feel free to raise your questions there, and if the time will allow us, we will respond to some of your questions. If not, we will come back and approach you directly with a response. And yes, we are recording the session, and the recording will be publicly accessible via our portal. So thank you very much, and let's start the session for today. And I will invite Stephan as moderator for our session to start with his presentation. Thank you very much, and enjoy.
Yeah, good morning, everybody, and thank you very much, Andrada, for the introduction. I have the pleasure to speak today a little bit about the supervisory priorities ECB published last November. And I believe this is a particular interesting development we can see in these priorities by looking back to prior year's supervisory priorities and this year's priorities. In fact, ECB was still rather confident and comfortable with the overall capital situation and liquidity situation, but clearly emphasized that there are new risks surging, and we are facing more global uncertainties in general. And the overall development we can see from my perspective here is that risks which used to be rather far away or uncertain at some point becomes more and more increasingly plausible, and unfortunately, as we have all seen recently, very tangible. So overall, these supervisory priorities ECB is now publishing for quite a while are a very strategic driven development on how they look at it. Yeah, it's always forward looking, or trying to be forward looking, but still keeping some continuity. Well, then let's look first of all into the different priorities and clearly focusing on the most recent ones. we are not hearing. This should be a technical issue. I guess everybody else should hear me, I hope. Basically, the first priority is strengthening the resilience to geopolitical and macro-financial uncertainties. This became clearly a core component of ECB. And when you compare it to prior priorities, it used to be a risk on its own and now became a cross-cutting risk basically across different risk categories. It impacts or it defines as well the prudent risk and sound credit standards in credit risk, which ECB sees, and it will impact as well clearly the new CSR3 implementation. There are quite a few changes in this area, with in the operational risk, for instance, going away from model-based standard to a risk to business indicator standard, and ECB will clearly incorporate this into their supervisory approach, and that means, from my perspective, not only in the SREP process but as well clearly in on-site inspection. At least that's what they announced, that they will run some horizontal exercises on it, and here ECB will very carefully monitor the implementation across the different banks. Prudent management of climate and nature-related risk used to be a topic. It is, from my perspective, a little bit out of the focus, but still there's many things to do. There's a follow-up on the prior year stress test, where ECB will check how the deficiencies or how potential deficiencies have been remediated. And I do not believe that this topic is going away as well. It's defined as a multi-year priority, so we can expect further activities from the supervisor here, how this would be incorporated in the governance framework of each and every bank. Same thing for the priority 2. It's all about strengthening operational resilience and ICT capabilities. This is particularly interesting if we look at the remedy deficiencies in radar. So if we look back 3 years ago, it all started with identification of deficiencies in BCBS 239. Then it becomes last year remediation, or emphasis on remediation. And actually, I was expecting somehow that this could lead to a more losing patience, as ECB is calling it, by penalizing insufficient implementations. But they stick to it, to remediation. But it's clear, emphasizing again this point, there was a lot of activities. We have seen many activities of the supervisor here, where it's targeting to push banks to faster work on remediation programs, and remediate the respective deficiencies. So this is pretty much aligned as well with the escalation letter ECB published. We should not forget that they are willing to use the instruments they have to push banks to work faster on the remediations. Implement robust and resilient operational risk management framework clearly targets mainly DORA. They announced as well further supervisory activities. This is a topic which will become even more prominent when it goes into the outsourcing topic on cloud services. And all this ultimately combines now with the medium to long-term priority from ECB, focusing on banks' AI-related strategies, and in particular the governance around this. So this is an interesting point for me, because ECB is not announcing exactly how they're going to integrate this into the supervisory approach yet. But this is a learning curve for them. They explicitly stated that they will speak to banks, run horizontal views, and this is something which will become more prominent, integrated into the supervisory approach from my perspective in the years to come. Overall, as I mentioned it for priority 2 on radar, the emphasis on remediation and acting faster and using the escalation instruments the ECB has at their disposition will become more and more important. And the one thing which we do not see here in these supervisory priorities, from my perspective, is the direct reference to the new guide on governance and risk appetite from ECB, which they published already in fall 2024, and which was supposed to be finalized in 2025. Clearly, the new EBA guide on governance came into the game here, and from my perspective, still prevents somehow ECB to finalize before the EBA hasn't done their work, and this is still under consultation. But overall, ECB made it very clear, as well for the supervisory priority, that governance is one of the top topics, and we will speak later as well on the new SREP process, where the governance topics becomes as well more and more important. So what ECB, from my perspective, wants to see overall for the new supervisory priorities is a really forward-looking risk management. It should be model-driven and not only reactive. Yeah, so it's all about a risk management approach and the risk governance around it, which is forward-looking in terms of anticipating upcoming risk and integrate in and being able to demonstrate that you are integrating these requirements into how you're running a bank. I mentioned it already. The prior supervisory priorities were primarily focusing on remediation, and this year, I believe we can see that the resilience to geopolitical shocks become more prominent. So I would expect that ECB is looking into this further in the different inspections. In prior years, ECB wanted to see the frameworks, the governance frameworks, the risk management frameworks. With a new supervisory priority, I understand it in a way that they want to see the resilience derived from these frameworks, so that banks are capable of acting according their own their own frameworks. So I would leave it here. It's a highly interesting and very dynamic environment from my perspective, and I do not believe that anybody would have anticipated really like 4 years ago that geopolitical stress or risks become that prominent in banking supervision. But it is like it is, and ECB is always looking to address this in time. So I would like to use the opportunity to raise a few questions to my esteemed colleagues here, and I would start with Przemek. Przemek, basically, as we have seen, the SSM priorities continue to evolve in response to the rapidly shifting European and global risk landscape. The ECB is clearly not only addressing existing and well-known risks, but trying to incorporate or incorporating emerging and still the less defined risk, how we can see it as well for the AI topics. But nevertheless, for geopolitical risk, based on your discussions with clients, what feedback are you hearing regarding this regulatory agenda? and how your clients are looking at these priorities, and how do you see actually your clients navigating through these growing and even sometimes a little bit competing supervisory demands?
Yeah. Thank you very much for this question, and let me share what we are hearing from our clients across the Europe. It's not only my voice, but what we jointly hear and observe. So practically, the one challenge is, how to navigate across, this dense, as you said, sometimes competing supervisory landscape. So first of all, banks see the regulatory agenda as increasingly broad and increasingly forward-looking. Across our client, one message is consistent. The regulatory agenda is expanding, not contracting. So, we've heard a lot about, deregulation, but in fact, the world became more and more complex. And from the risk perspective, it has to be addressed. So supervisory have moved just beyond the traditional set of risk, capital, credit, liquidity. What I believe we managed pretty well, and we can measure very well. And now we are embedding newer, more complex risks to reflect this new, more complex world that every single day can bring us, new challenges. So it covers, this geopolitical risk, climate risk, the third-party concentration risk, digital and cyber resilience, even the structural business models, sustainability is challenged at this time. So banks understand why this is happening. So the risk landscape is more interconnected, interdependent, and I would say even more unpredictable, that at any point in the last decade or maybe even during the whole time. But it means that the institution feels that the regulatory agenda becoming more demanding and in some areas also more urgent to answer these challenges, how we address. And also leave some flexibility, because we are addressing the risk we do not necessarily, let's say, address previously. So we need a little innovation to measure, address them, and in different geographies, different responses, different approaches can be adequate. Clients also tell us that the biggest challenge is not the number of priorities, but the fact that they are happening at the same time. And I believe there are two reasons. So, we can deal with every single risk on its own by the way they are coming together to us. The one thing we need time to deal with them, but on the other hand, this interdependencies simply brings the risk of, I would say, heavy tails. That together they bring additional risk like intercorrelation. And basically a recurring point what we heard is that supervisory priorities are no longer coming in sequence, they are arriving in parallel. So that's how the world look like now, and that's how we have to respond to it. So basically the way to address it is to strengthen governance. We already observe it, to integrate geopolitically risk, climate scenarios, upgrade data and risk infrastructure, because the time will be the essence, but also, having the right data, we can build model better or worse, but we can rely on them, we can adjust them. Without data, it's more like guessing. And, the reinforce ICT and cyber resilience capabilities, that's also one of the biggest risks we have observed that materialized in our region. And maybe the last, dimension. I also believe this is the very first time in a few years when the way we implement regulatory agenda became a kind of, strategic choice. There is a space to implement it differently. There is a space to select how fast are we going to implement. The regulations also bring some flexibility, we can make some things maybe a little more general, but we also can stay with more detailed analysis that we used to do. So also, this deregulation, the intention was to let in some areas to report some risk in more general way. So maybe the regulatory arbitrage, that is not the right word here, but I believe some banks can get advantage thanks to the different implementation of the regulation. They can do it, faster. They can spend more money on it. They can decide whether to use some simplifications, but it again costs or wait maybe some time to decide and implement the new version of regulation that we can enforce, as we are observing that the regulatory agenda is changing every year. We also observe that some challengers, like the new digital banks, are entering the market with slightly different approaches to, with products, with like tokenization, cryptocurrencies, approach to KYC. We observe few banks that are losing clients due to the KYC project. So basically the KYC and the approach, let's say, generally to some regulations became a strategic choice how to approach it, and can give strategic advance, or you can lose some part of the market. So we again see the optimization of RWA, which was not focused for quite long times. AI, as you said, this is risk against reward. This is also a kind of tough decision to be made, and how to do it. So basically, the effect of this implementation are visible to customers, can decide these choices. We are observing also, in the DORA, for example, that across Europe, there are different approaches to implement. There are different stresses and areas to focus based on the history and where the real risk result. So basically, apart from, this, I would say the regulatory agenda and the areas of focus, now we can say this is the time also for risk regulatory strategy for banks to make choices and decide how and where to go in the nearest future. Thank you.
Yeah, thank you very much. Yeah, the overall strategic approach is super important. Looking at one of the risks in a little bit more in detail, Andrada, speaking about credit risk. The ECB reported in their 2025 SREP result that they are still rather comfortable with the asset quality across the significant institution, though there might be some regions in Europe or some sectors which are a little bit more vulnerable or exposed to higher risks. But for now, the supervisor does not see really an acute systemic concern about the banking union. However, they made it very clear, and I emphasized before that governance is a topic, that they still see substantial deficiencies in some areas of the credit management process. So that the supervisory measures are more focusing qualitative supervisory approach, and that the supervisor will look more at the credit risk management practices, including underwriting standards, credit risk monitoring frameworks, and so on. So, Andrada, given this environment, having stable headline credit metrics, but heightened supervisory scrutiny, what concrete steps actually should banks take to prepare for these more granular credit risk examinations to be expected, because ECB announced them? And where should they focus to ensure that they can demonstrate high quality new lending, and in particular of forward-looking modeling, early warning capabilities, and robust, well-calibrated provisions, all this under the topic priority 1, geopolitical risks?
Thank you very much, Stephan, for the question. So indeed, we assisted in the recent years to a very good credit risk evolution so far. although was noted also by ECB, and also this is our perception as well, there are certain geographies that already show some signs of deterioration, modest, but they are already visible, especially in the last month. This is somehow also strongly linked to what the supervisors are expecting, because they are clearly signaling the fact that this is the precise moment to strengthen the fundamentals and the governance. Because when the asset quality is stable, expectations around discipline, governance, forward-looking risk management becomes even higher. So I will respond to your question exactly in the structure that you provided, on the three main pillars: high quality origination, proactive monitoring, and robust provisioning. So first of all, when we are speaking about high quality new lending, everything starts with a forward-looking risk assessments. So if banks rely predominantly on backward-looking financial indicators or point-in-time data, the quality of the newly originated portfolio will be inevitably deteriorated when the cycle is turning. So the key here is to embed forward-looking non-repayment risk assessments at the moment of the origination. So this means that banks should leverage new modeling techniques. One way to do it, one aspect to consider, So for example, machine learning approaches, granular behavioral data, alternative data sources, in certain cases, sector-specific leading indicators, and obviously all these things combined with macro and financial scenarios. The good part is that today we benefit from far more accessible data than before. So I'm referring to transaction data, real-time payments behavioral, sector analytics, ESG, climate, other climate metrics that are available, and so on. So banks should use this enhanced predictive power, especially for SMEs and specialized lending, which are two of the most, let's say, areas of focus of ECB and the supervisors. However, because I was referring to advanced modeling, all these things should not come at the expense of governance, because supervisors will look closely at model explainability, validation, and documentation. And in cases when underwriting is based on AI models, on AI systems, this underwriting process must be free of biases and aligned with regulatory expectations, because recently we know that there are a lot of regulatory expectations around AI, and I'm referring to AI Act, even EBA guideline on loan origination and monitoring has different components regarding to this, and so on. And here somehow there is a strong link with priority number 2 and the fact that you already what you already mentioned, Stephan, at the beginning. For the moment, on a very, very short term, we do not expect ECB finding or dedicated on-site inspections on AI area, because still ECB is an understanding phase on how banks are using AI in their activity, which are the main use cases, which are the most impactful, from a risk management perspective. And later on, we'll start more actively the actual review activity. So we expect in the upcoming years very intense conversations on the topic. But they stated very clear that this type of assessments will be done in collaboration with other institutions responsible for AI, for example, for the implementation of AI Act. My advice for the moment for the banks is to take benefit from this, let's say, gradual period or transitional period in terms of supervisory approach, and make sure that they have proper AI governance and strong model risk management framework. Also on the loan origination and underwriting, I would like to mention the fact that this process will be subject to automatic review in 2026, recently announced by ECB and highlighted even in one of the speeches from last week. And one of the focus area will be exactly data availability and collection. ECB will perform a benchmarking exercise following this thematic review and will share the results with the banks in order to help them improve their lending practices. In fact, here ACB already started collecting some information from the banks, and one of their findings was that most of the banks are looking primarily from a business point of view, new volumes, repayment type, and other basic KPIs and KPIs, but they do not consider the quality of the new lending. So banks should expect a lot of conversations on this area. Now, the second point, maintaining portfolio quality requires early warning systems, so the monitoring processes. Here, the supervisors are focusing on whether the banks identify deterioration early before the clients experience visible financial distress. Modern early warning systems should go beyond the traditional arrears triggers or days past due. They should integrate behavioral signals, transaction patterns, covenant trends, sector-specific stress indicators, macro variables as well. And here again, I'm highlighting the new modeling techniques and richer databases that can significantly enhance the predictive capabilities of a potential distress. ACB is placing a special attention for sector or types of clients under supervisory scrutiny, and I'm referring here to commercial real estate exposures and SMEs. We already see a number of on-site inspections running on these areas. And the focus for these OCIs are mostly on collateral valuation practices, foreclosed assets procedures, specific KPIs and early warning indicators for this type of lending processes, covenants monitoring, and so on. So here, the advice for the banks would be to proactively review their commercial real estate portfolios rather than waiting for supervisory findings. And then the last point, provisioning, which should be granular and well calibrated. ACB and also other supervisors are challenging broad umbrella management overlays. Overlays can be appropriate in periods of high uncertainty. They should be client or portfolio specific, supported by data and very clear documentation around it. Forward-looking expected credit loss models should incorporate macroeconomic scenarios that are plausible, differentiated, and consistent with the risk appetite. And only when model limitation exists, targeted overlays based on sector exposure or borrower characteristics are more defensible in front of ACB and the supervisors rather than generic top-ups. What is also important to have in mind that these three elements, provisioning, underwriting, and monitoring, should form a coherent loop. So weaknesses identified through early warning systems or sector analysis should feed back into tighter underwriting standards and updated risk appetite limits, and obviously impact on provisioning as well. So we really see supervisors increasingly assessing this internal consistency that should exist at the level of the bank. And one last point from my side, and referencing back to what you said, currently we are living a low NPL environment. Behind all these intentions of the supervisors, there is a clear message. Low NPL ratios today are not a guarantee of the resilience tomorrow. And the quality of new lending decisions taken now will determine the asset quality over the next cycles. The banks that invest now in forward-looking analytics, disciplined governance, coherent risk frameworks will be the ones best positioned to meet supervisory expectations and to sustain strong credit performance in the future.
Yeah, thank you very much. Credit risk remains a classic, but there seems to be a shift on the qualitative aspects a little bit. Staying with the priority one on geopolitical risk, because it's the driving agenda point currently, I guess. Spyridon, we all know that ECB is currently conducting a dedicated geopolitical stress test this year. You lead our European geopolitical stress test working group. which is already heavily engaged in this topic and closely connected with different banks across Europe, and our teams working already on these projects. So asking you, from your perspective, what are currently the main challenges institutions are facing, and what are the development we should expect as the supervisory examination process of geopolitical risks will rather intensify in the coming years?
Okay, so Stephan, first of all, thank you for your question. I shall be grateful if you could please let me start from giving a broader perspective and taking a step back on the supervisory priorities. Summarizing what we have already discussed, technological development and geopolitical challenges are shaping the environment in which European banks operate, and they act as the main drivers towards setting the supervisory agenda and priorities. If we would like to conceptualize the current environment through the lens of statistical distribution, this would be a chaotic one, which will be characterized by fat tails rather than a stable central tendency. On the one hand, we have the lower downside tail, which is increasingly influenced by geopolitical risk, and which can crystallize abruptly and with significant adverse impacts, as we saw even during these weekends. And at the same time, the upside tail is shaped by technological innovation, which can generate disproportionate gains, but also reshape competitive and risky dynamics very quickly. So the majority of the initiatives undertaken by the supervisory authorities, especially in Europe, are directly or indirectly related with those two driving forces. So in terms of the lower fat tail, so namely geopolitical risk, and back to your question, from the perspective of our European geopolitical stress test working group, drawing on our close collaboration with a broad range of institutions across EU, the key challenges we are facing are attributed primarily to the very nature of geopolitical risk and geopolitical shocks and its intrinsic characteristics. So a primary challenge we have observed during the recent geopolitical stress test, which is currently taking place, concerns the design of a severe and yet plausible geopolitical scenario. So geopolitical risk is inherently dynamic, and it is subject to rapid escalation, which complicates scenario selection within a fixed time horizon, as the one that is used during the ECB's exercise, so namely 3 years. The recent developments in the Middle East during these weekends, with the closure of the Strait of Hormuz, illustrate this challenge very eloquently. With hindsight, we can say that definitely energy is a critical channel, and a surge in energy prices risks reigniting inflation in major economies, derailing even central bank rate cutting plans, and shaking business confidence, all factors that should be captured in the context of this exercise. So, on that respect, a legitimate rhetorical question arises as to what extent had institutions incorporated scenarios of this nature and magnitude, or analogous scenarios to that, into their scenario palette for the current exercise. So, this highlights why banks need to enhance further their internal capabilities to identify first geopolitical shocks and to decide proper scenarios and analyze how they materialize through the various transmission channels. A second challenge we are currently observing relates to the transversal nature of the geopolitical risk. So, namely, geopolitical risks rarely materialize through a single risk category. Instead, they propagate through interconnected and mutually reinforcing channels, spanning credit, market, liquidity, operational, and also cyber risks. Even within the structured methodological framework proposed by the ECB, institutions often face complexity in ensuring internal coherence and correlation across scenario variables, particularly when translating geopolitical narratives into assumptions for macroeconomic variables, market movement, funding conditions, and portfolio behavior. Ensuring that these interactions are logically sound and internally consistent remain a demanding aspect of this exercise. Finally, and another important point refers to the fact that a well-recognized constraint refers to the fact that we have a limited availability of relevant historical time series. So as I have already mentioned, geopolitical shocks materialize abruptly, and we do not have a distribution of historical events and patterns to observe. So many of the geopolitical regimes of concern today, namely energy shocks, fragmentation, sanction escalation, trade disruptions, or even armed conflicts, have few close historical precedents at the scale and interconnectedness of the current global financial system. So as a result, institutions are necessarily constrained in their use of traditional statistical techniques and are increasingly reliant on expert judgment, proxies, and stress elasticities. So this places greater emphasis on the transparency, traceability, and internal consistency of assumptions rather than on statistical precision. Another important point that finally our working group consistently observes is the credibility of geopolitical scenarios, which is accelerated as a systematic monitoring of country-specific developments, sanctions regimes, etc., takes place. A small number of globally systemic important institutions that we are working with have begun to formalize such capabilities through dedicated geopolitical or country risk intelligence units that interface directly with economic analysis and risk functions in order to support strategic and risk decision making. Okay, but we have to recognize that this remains an area, an evolving area across the industry. With regard to the second part of your question, with regard to the forward-looking supervisory perspective, looking ahead and based again on our dialogue with institutions across the EU and also with the ECB, we would expect the supervisory scrutiny to increasingly focus on three areas, primarily the credibility and discipline of bank-specific scenarios. So, namely, the capability to identify shocks and also to develop plausible scenarios that can be articulated through the transmission channels from geopolitical shocks to capital and liquidity impacts. Secondly, the degree of integration into internal risk management processes, particularly ICAP, capital planning, risk appetite, ensuring risk management continuum, and also preparedness and executability, including governance escalation, management action frameworks, and operational readiness and resilience, recognizing that geopolitical shocks often unfold rapidly and non-linearly. In summary, the challenges that we currently face is not about how to perform a precise estimation of the potential impact, but to build the ability and to operationalize the framework for the identification and articulation of geopolitical shocks in order to be able to provide the next step for the existing risk management frameworks. So that's all from our side.
Yeah, thank you very much, Spyridon. Speaking about the dynamics, the unfortunate dynamics in geopolitical risk, I believe when we prepared this meeting here on Friday, it was a different world we see this morning, actually. So, and anticipating this is, I guess, the part which will drive the efforts of ECB. Still staying a little bit with this top priority from my perspective, Przemek, you are based in Poland, and speaking about the stress test from ECB for this year, there are quite a few banks and geographies which are technically not directly impacted by the stress test because they're not ECB supervised. However, the topic is there. So my question to you, how do you see this stress test and the parameter of the stress test influencing banks outside the ECB's direct parameter? And from your perspective, reflecting your geography and maybe beyond, how should institutions prepare for such geopolitical scenarios to meet actually the formal part of supervisory expectations and implement risk management practice?
Yep. Thank you very much again for this question. And I believe the reason we have chosen me to address this question is, the very specific situation of Poland and the perception of Poland a few months ago. So we were exposed significantly to the war at Ukraine. It's close to us, and all these economic interdependencies were quite obvious. So few thoughts that I can share, let's say, with other geographies is that, after the war started, we analyzed these individual interdependencies on the level of BICS exposure. It seems quite straightforward. What was interesting is that, the CROs observed the risk, identified, the provisions were calculated, but they were not materializing. So basically, it shows that the economy and the companies were much stronger than it thought. They were able to adapt to new situation, and I believe it refers to the whole Europe and the whole economy. So this low materialization also resulted in the releasing of the stage 2 provisions in 2024. 2025 results, full results are not disclosed, but that's also what we are observing. And that's, of course, the obvious first step to be done. On the other hand, what is also quite, intuitive is that the more complex analysis coming from the, let's say, something that we can call, the second and third derivative. It's not who is buying from you and where you are getting things from, but basically if these clients and suppliers will get the money again. So that's the kind of risk we have. And what Spyridon mentioned also is, whether the, let's say, contamination effect, or I would say overlays of different sources will impact and how they will result the whole economy. So we can call it the heavy tails. And the analysis of the sector analysis, that's what was mentioned is quite obvious. So models and factors will differ across countries. They will have uncertainty, volatility. We'll have a space to somehow analyze it, and we have to look at other countries to find out what they are looking for, what they find out. I started with the sentence that, a few months ago, Poland was like a good, let's say, source to analyzing it. But 1 or 2 weeks ago, I attended the Nordics webinar, and I realized that some of the risk we didn't point it out in Poland were observed in other countries. So, the whole Greenland topic, how does it impact economy, what it can bring to economies, what can be results. So my advice would be look at the other countries, look how they are dealing with the challenges, what approaches they are using, and analyze whether they will somehow be applicable to your regions, your countries, and maybe just to leverage it. So, we have so many different topics like, Greenland, Ukraine, the Taiwan, China. Now we have the Iraq, that it's really hard to develop every single model in advance. We have to try, but basically the adaptability, also, the agility, this is the name of the game as of now. And one of the questions we had, it was what to do if there is no data. Yeah, I believe in many cases there will be no enough data to model it properly and just to base on data, fully base and rely on data. We have to use the data as a kind of guidance for, stress testing, giving the directions, but in many cases, the rationality, the substance over form, the analytical mind will play the key role in this area. So due to the matter of time, maybe I will also pause here. So let's go further. Yeah. Thank you.
Yeah, thank you very much. These are challenging times. However, Sascha, now we have discussed supervisory priorities, and all this doesn't seem to immediately suggest that regulatory expectations or regulatory burden is easing. However, at the same time, the ECB is now actively working on supervisory simplification, and there have been quite a few publications of simplification initiatives. There have been reports. So my question to you, what are the core measures the ECB is proposing actually to streamline its supervisory and reporting framework, and what practical impacts bank could expect from these simplification efforts in terms of potentially reduced complexity or clearer processes or more proportionate supervision? Is there light at the end and at the tunnel, not being the other train coming in?
Yeah, thanks, Stephan, for that. And first, perhaps on the wording. So the word that the ECB is using is simplification. We realize there's a lot of press coverage also out there that speaks of deregulation. I think it's very clear that the ECB is not using this term because it's not reflective of the more cautious nature that the regulator is taking. And also the ECB has made it very clear that it does not intend to bring overall capital requirements down, but it wants to basically target the administrative costs by reducing complexity. So that is the overall objective that the ECB is pushing forward. So first, what are the facts? The ECB early on in 2025 established something that called the High-Level Task Force on Simplification. That has essentially one core mission, and that is to identify unjustified complexities and hence propose solutions for that. The task force then produced a report containing 17 recommendations. The report has then in 2025 been endorsed by the ECB Governing Council. The report, of course, does not exist in isolation, but was preceded by other initiatives by the US, by the UK, but also Germany with very far-reaching initiative for small banks. So as a result, expectations also for the ECB from the very beginning were very high. So on the various recommendations, there are three groups of recommendations. First, there's a block of 9 recommendations for the regulatory framework. This is also these are also the recommendations that are listed on the slide. And there are further 2 recommendations for supervisory framework, which also includes this SREP, and finally 6 recommendations on the reporting framework. On the various proposals on the regulatory frameworks, again, these are the ones pictured on the slide. There is quite a lot there. There are some on the composition of own funds. There's also some language on broadening the scope of SNCI and simplifications that apply to SNCI. There's a recommendation on loosening the burden of stress testing by ways of various levers that the ECB is proposing. There's also some language of bringing MREL and TLAC closer together, and also some mentioning of further banking union integration by pushing forward EDIS and the savings and investment unit. And that's just mentioning a selection of those. Not to forget, as I said before, there are also other recommendations with regards to supervision and reporting, like completing the single rule book, and further coordinating between supervisory bodies that, as we know, have a tendency to request the same kind of information multiple times. So the scope is wide, but let's perhaps focus on one or two of these recommendations. The one recommendation that has attracted a lot of industry scrutiny and a lot of pushback is the one that speaks to AT1 instruments, and that is the recommendation here, number 2, adjust design the role of capital instruments. So the recommendation is that basically to reduce the capital instruments framework or improving it by first option, either removing all non-equity instruments from the own fund spectrum, or second option to make sure that AT1 is more similar to equity in its way of how it absorbs losses. So the ECB has in a recent telco also been asked to clarify its intention in a more accessible fashion. That is what it means by making AT1 more similar to equity. It hasn't really said much about the concrete details about it. It has repeated that these are high-level recommendations, and the ECB is not a legislative body. We believe the main pushback from the industry so far while the ECB has called this a simplification, this as a result naturally limits the bank's ability to issue own funds. So very, very clearly also going forward, we expect this to be heavily discussed between industry and regulatory bodies. That's the one recommendation that I would like to focus on, and then the other recommendation that has also attracted a great degree of scrutiny is the one that speaks to the overhaul of the buffer regime. So the proposition of the ECB is to take all various buffers and all the categories that we have in the EU and replace them essentially with 2 buffer categories. That is one that's called the releasable and one that's called the non-releasable buffer. The releasable buffer is the one for the macroprudential authorities on a national level, and is to include the countercyclical and the SI buffers. The countercyclical and the systemic risk buffer, and the non-releasable buffer would contain the conservation buffer and the SI buffer. So P2G then would sit on top of these 2 new buffers, but also here the key question remains. There are various buffers still remaining, and the requirement is, or the question really is, which requirement will become binding first, and how will this translate into MDA restrictions and supervisory pressures going forward? So this is all very unclear still. So also here we are reminded of the very high-level nature of these recommendations, and we're looking forward to seeing this in a more detailed form. So what will come next? Only very briefly, the ECB is adamant in saying that it does not have the legislative power but instead the report will be or was submitted to the European Commission, which will now use it as an input into its reports on the competitiveness of the European banking sector. In general, it is very hard to predict which of these recommendations will make it into the final Commission report. We think that it's very unlikely that the Commission will not push forward on some of these recommendations and include them in the final report, particularly in the context of the current political undercurrents. But in the end, if and to what extent it will form parts of any final regulation or legislation, and thus may have an impact on banks, which naturally is the most interesting point here, and how this funnel will look like is very difficult to anticipate, especially in the absence of more detailed information. But we understand that there will be some more forthcoming information, and once this is available, we'll put that into another briefing. So that's it for me, and thank you, and back to you, Stephan.
Thank you very much. So this is clearly a lot of work, and it's clearly as well, as you said, no deregulation, but simplification and increase in efficiencies. In being conscious of time, actually, a quick last question to Andrada. One of the initiatives for the simplification is the SREP reform, yeah? And the ECB has the ambition here to shift toward a clearer, more focused, more strategic SREP decision and a stronger focus on material weaknesses, governance, and risk prioritization. That raises for me the question, Andrada, actually these are things which are existing. Do you think that the revised SREP might give banks more room to influence somehow the outcomes of the SREP process by demonstrating stronger governance, better risk management practices, and initiate timely remediation of known deficiencies? And is the new SREP an evolution, or will it ultimately become a revolution?
Thank you, Stephan. In the interest of time, I will be very, very quick. So on this topic, we already have several key messages from ACB, either via supervision newsletters or via different speeches of the board members. So here the main idea is the fact that this entire SREP reform, or the main purpose, is to design a supervisory approach in a more clearer, more focused on the key risk drivers and much more selective, in which ACB will flag for escalation. Yeah. So they explicitly state their long list of findings will be replaced by more strategic assessments, highlighting only those weaknesses with material impact on score or requirements. So basically, we assist to a shift from a retrospective compliance to a forward-looking risk ownership, and the ACB is not longer primarily interested in how well banks explain the past, but in how early and credibly they can identify the future deterioration. So indeed, coming back to your question, definitely if banks will have room to influence their SREP scores to stronger governance. So if a bank can demonstrate that deficiencies are clearly identified, the root causes are understood, timelines are realistic, execution is disciplined, this does influence the supervisory dialogue and ultimately the SREP outcome. ACB is less concerned about the existing of the issues per se, because every institution has them, but they are very focused on how these issues are managed. So timely remediation, strong internal controls, clear accountability at board level, and evidence that lessons learned translate into structural improvements can significantly shape their supervisory perception of resilience. So back to you, Stephan.
Yeah, thank you very much. I think the topics we touched upon here is something where we can definitely spend more than an hour, but we're running now out of time. I would like to refer you to the upcoming sessions in the week, and I hope there's something for everybody. I spoke a little bit about the importance of the radar initiative. We will have a dedicated session on this, I think tomorrow. I can only invite you to participate if you're interested. Then let me thank all of you for dialing in. I hope we could give some updates here, and looking forward to see you again in the upcoming sessions. Thank you very much, and have a great start into the week. Thank you. Bye-bye.
Bye-bye.